thank you all for coming. As was mentioned, my name is Luca Gori. I'm a partner at DLA Piper, the global business law firm based in London. I'm the co-head of the Emerging Growth and Venture Capital Practice, and I think this is a great event, and I come here so often that Charlie and Jim have hired me to do their job of introducing the guests. So here we go. The first panel is Supporting Your Portfolios in 2023, What Lies Ahead, with Chris Wade as moderator. Chris is an experienced founder, advisor, startup mentor, and technology executive at Isomer. Prior to Isomer, he was the founding director of the venture capital unit for the UK government, where he cultivated over $1 billion invested from the US and Asia into fund and direct company opportunities. As a venture partner at Octopus Ventures and Entrepreneur First, he's an active value-add non-executive director and has mentored over 15 companies to successful seed funding. Chris co-founded Cambridge Positioning Systems, which was sold to a global semiconductor in 2007, prior to which he worked for 15 years in a technology operation of a US-based DSC, where he assisted in its $4 billion sale to Alcatel. Chris holds a BSc in physics and chemistry from Leeds University. Please welcome Chris.
Good morning. Is it morning still or is it afternoon? It's morning, right? Now, the problem is we're sit here and we're a customer-centric bunch of people and you're all over here. Now, either we can move or you can move. What should we do? Will you move? That's very good. If you could move in the middle, that would be great. Because we like talking to people. Please. While you're moving, hello, Martin. No difficult questions today, please. I would like you to put your hand up if you believe when we're here this time next year, the situation in our venture capital world will be better.
Room full of optimists.
Can I conclude that the majority believe it'll be either the same or worse? Is that fair?
Worse.
All right.
Say worse. Really?
Well, there we are, ladies and gentlemen. We know what the audience think. Let's either agree with them or disagree with them.
Is my mic on?
We're talking about how do we support the most important asset that any of us in this room have. It's called the entrepreneur. Without the entrepreneur, there is no venture capital. There's certainly no fund of funds for venture capital. So I wanted you to introduce yourself, starting with Miles, a little bit of who you are and what you're doing, but in the context of how many portfolio companies you have, what sectors they're in, and what stage they're in.
Fantastic, thank you. So Miles Kirby, CEO of Deeptech Labs. My background, actually, I was with Qualcomm for 18 years, ran the venture capital group in Europe for a number of years, set up a fund for Allianz and now running Deeptech Labs, which I'll talk about in a moment. So what we do is we're set up with the University of Cambridge and Arm, and we are very focused on deep tech companies, as you'd probably expect, given Deeptech Labs is our name. And so what we do, though, is we've got a very intense sort of support structure around our portfolio companies. So what we do is we invest in 10 companies a year, and we bring them through a 10-week program. And so what we do is it's really all around ecosystem. And so what we believe is that you need a great ecosystem around companies, and especially deep tech, because it's often very challenging to go from sort of a new technical idea to a real business. So we bring, we've got over 400 people in our network that come work with our companies. We run a 10-week program. When we talk about intellectual property, we have the ex-head of IP from Qualcomm, the ex-head of IP from Arm. Marketing, we had the CMO from Salesforce. So fantastic sort of, founders of Arm, founders of Cambridge Silicon Radio. And we think that's really important to bring that last generation of entrepreneurs to share that knowledge and that network.
Okay.
And so that's what we're doing.
You do 10 companies a year.
Yep.
You're doing 10 companies in 23.
That's our plan.
Eileen, tell us about you and your portfolio and what's going on there.
Great. I'm Eileen Tanghal. I am founder of Black Opal Ventures. I know a lot of you in here because I've had kind of different stints in venture capital along my career. Started as a financial VC, well, first as a startup company that was venture backed and successful when IPO in 2000. Then I was a financial VC here for Amadeus Capital Partners and Kennett. Moved over to, in 2008, to Applied Materials, ran the venture capital fund of Applied Materials for several years, up until 2015, then was at ARM. So I know a bunch of people here from ARM, 2 years running new business ventures before SoftBank acquired ARM. And then before starting Black Opal was with In-Q-Tel, which of course have been on stage. And I was a senior partner in the investment team at In-Q-Tel in Menlo Park, and then am co-MD here in London for the last year and a half. Black Opal Ventures, I know you would have seen if you're following me on LinkedIn, especially those of you who I've known for a long time, that Black Opal Ventures is a brand new firm, really connecting two distinct worlds. We're taking tech that's been in defense and intelligence, largely, or enterprise, and intersecting it with the life sciences and healthcare industries, who unfortunately don't know that this tech exists and can be utilized to improve patient care, patient outcomes, et cetera. We are backed by a major pharmaceutical company as an anchor of our fund, but a number of healthcare systems that are involved, that are investors, as well as a number of high net worth executives in tech and healthcare. Now, what do we bring to the table as Black Opal? We are a minority female-led fund, financial fund. I dare you to find many others because we are underrepresented as people in this sector. So what do we bring to these companies? One, these companies that sell deep tech into enterprise or into the government, they don't know how to get into healthcare. They don't know how to get into life science. We do. We have backers. My partner was chief medical officer of McKinsey. She is a successful entrepreneur herself in the space. So we help them get into there. On the flip side, we help the healthcare and life science ones understand the tech. And then finally, most of these teams, I've sat on about 40 different boards. I am normally the only female, if not the only female and person of color in almost every board I've sat on. And most of these entrepreneurs, this is a new age, folks, they want diversity on their boards, in their management teams, and we have the networks to do it. So we bring that to them as well. So money, people, capital, and of course, customers into life science and healthcare.
Fantastic.
So we are aiming to be a $75 million fund. We have $55 million under management currently. We've closed $50 million thus far, made 6 investments,
So
and we will do 20.
Let's be clear.
Yeah.
There is a few just available slots for anyone here, I suppose.
That's right.
If they're good enough.
That's right.
I think you should listen to that, ladies and gentlemen. Actually, it's gone. We don't need to
Also for Deeptech Labs as well.
We don't, and deep
Yeah,
yes,
that's
rating
right.
too, right?
That's
Okay.
right.
So there's a few pennies left for you, and maybe.
Oh, actually, a lot more. We're only 20% deployed, so we have 80% of our fund to deploy.
Fantastic.
Yeah.
George, do you need money?
No, I'm 100% committed. So George Kellerman, Managing Director of Woven Capital. We are an $800 million growth stage fund backed solely by Toyota. We're unique in the industry. We have a sister fund called Toyota Ventures. They do seed and Series A early stage investments, but we're a growth stage fund. So we're really focused on Horizon 2. The investments that we're making are anywhere from $10 to $50 million, and there has to be a strategic tie-in to the company. We're not just doing moonshots. There actually has to be some strategic roadmap where we're accelerating the existing business, so more Horizon 2 type of investments. We just launched in the beginning of 2021 in the middle of COVID. I actually set up the fund from my house in Silicon Valley. I live in Tokyo now. But we had a challenge hiring people. So we actually didn't do a lot of direct investments. We've only done 4 to date. And we have 1 term sheet where we're actually leading an investment, and that's in negotiation. But I actually wanted to focus in the early first 2 years on fund-to-fund investments because I wanted to accelerate our coverage globally and make sure we had the right deal flow. So we've done 9 fund-to-fund investments, and that was really the priority in the first year and a half. And that's actually worked out very, very well for us in terms of creating deal flow and giving us access to the right kinds of companies.
George, you start your fund possibly within weeks of the peak of the current sort of bubble, in 2021, and it's been a bit different since then.
Yeah, we've marked some stuff down.
But just let's talk about that. talked generically about this, but as a fund manager, I know you've got just one LP's capital, but you have to worry about that. Talk us through the impact of that in your discussions with your portfolio as those things happen.
Well, the main thing, we've been lucky. Because we're coming in at the growth stage, the companies that we're backing tend to be raising larger rounds, and they're thinking long term. In fact, they're getting ready to go public, or actually they're hoping, or at least when we did our investment, they were hoping it would be their last round. They're well funded, so we're actually quite lucky. None of our portfolio companies, our direct investments, are struggling at all. I think the bigger challenge that we're seeing right now are the new investments that we're trying to make. When even if we want to lead the round, they're still struggling to pull the syndicate together. There's still a lot of financial investors sitting on the sidelines. I like to think that because we're Toyota, people are thinking, oh, well, there's a good strategic tie-in, so this is going to have some potential. But at the same time, it can scare some investors away because they'll think that they're locked into Toyota. And we want to make sure that they're not. We actually act more like a VC. If we wanted to lock them in, we'd buy them. So I'm actually dual capped. I also run corporate development for Woven by Toyota.
So your portfolio, you've chosen well, they've got capital. I guess they're mature companies, means that they can probably be profitable or don't require to burn cash. And your problem is the new investments and finding investment. Is that
correct?
Got it.
Well, and I'd actually say it's what we've started to have to do is, particularly like the round we're leading right now, we had to put in a minimum first close to make sure that the company actually had enough money to operate. We didn't want to be the only money in. And they struggled. They found it, but they struggled for a couple of months to find those other investors to get to that minimum close amount.
Eileen, how's your portfolio?
Yeah, so we made our first investments only in July last year. So the nice thing is
July,
2021.
So the writing was on the wall.
Correct.
Clearly.
So we had very good valuations. We made sure these companies had 24 to 36 months of cash. So the portfolio is actually pretty safe. The nice thing, of course, of being an investor, and we all know this right now, is that valuations are coming down, and we're getting really good quality companies at very good valuations. And then, of course, what's happening in the companies that can't raise, they're raising bridges that are led by their insiders. And the bridges are open with discounts and caps and really great things if you believe in the company, the entrepreneur, and the technology.
This is a superb secret, actually. There has never been a better time in recent years to invest in venture capital, because you're getting in at a much lower price point, and there really is, within reason, only one way up.
Well, I'll also add, SVB has gone under. So because SVB has gone under, the typical bridge financing that would be available to, especially the Deeptech ones, is not there. So I don't know if anyone's ever done the SVB calculation, but I'm sure they did very well because they're the top of the stack. They have interest, plus they have, and that's what you get if you invest now and act like a creditor. So it's good.
Miles, you're doing Deeptech. Takes a long time to get to revenue. You can't just send an email out, please all go profitable. That's going to go in the delete bin pretty quick. So what are you saying to your portfolio?
So a few different things. One is obviously make sure you've got sufficient runway, and obviously be cautious with the cash you have. But at the same time, I think there's a real sort of flight to quality. And so, there's a lot of VCs.
Is the implication that there wasn't before, that all of us were investing in nonsense?
Not us.
No, not us. Not us.
Clearly
not anyone
us.
in this room, but there were some others. So I think there was, I think there was a lot of money out there. There was a lot more competition, if you like. And so I think some of the mid-tier companies, if you like, were getting funded. And I think what we're seeing now is that, only the best companies are getting funded. And I think that, for example, in our portfolio, we had had a couple of companies that came through the program at the end of last year, and one company had 5 term sheets, the other one was 50% oversubscribed in their seed round. So I think for the best companies, there's definitely money out there. But actually what we're seeing with our accelerator program and our demo day is that's actually becoming more and more valuable to companies. So, coming through the program, having that stamp of approval, and then, we had over 250 investors coming on to our demo day. So what a great way to be able to get exposure in one go to all of these VCs. So I think there's definitely, a flight to quality there.
I'd like to say to everybody, if anyone has an urgent requirement to make a question, just put your hand up and shout, because that would be great. You do.
I just want to follow up on something that Eileen said.
Asking you, actually.
She was saying, the company's having 24 to 36 months of cash. During the heyday, I would see investors say, no, you're raising too much. You're going to take too much dilution. Take 12 to 18 months. And so that's something we're definitely seeing, like minimum 24 months. If you don't have 24 months, don't think you're just going to flip it and you're going to start getting another round. Yeah. And so it is becoming 30 to 36 months is the amount you need to actually weather the next couple of years.
Now, Eileen, I've rehearsed this next question 6 times, and I'm probably going to get it wrong.
Uh-oh.
We were in Cambridge a long time ago. I was building a crazy company. You were at Amadeus.
CPS. That's right.
Amadeus. So,
2006,
sort of a short way of saying that you've seen a few cycles before.
I see, because I'm old. Got it.
Tell us. Absolutely not. Tell us. Well, no more or less than anyone else. Tell us what's different this time round.
What's different this time around from my point of view?
Yeah, from your point of view. I mean, you've seen these cycles.
So, right. So this is the third one I've seen, right? So I was there in 2001, I was there in 2008, and now we are. I think, let me go with what's the same. What's the same is everyone does the barbell strategy. We're either going to do seed or we're either going to do late stage stuff.
Right.
That's one. Second difference, there weren't that many corporate venturing arms back then. And it is awesome to be a corporate venture at this time because, especially if
does anybody know what those stats were?
Like 10, 12. Actually, where's Jim?
What, in 2000?
In 2000, maybe a dozen.
10.
A dozen corporate venturing arms.
And what there's now, 500?
Look at here. Remember, it used to just be like.
You know these things.
3 times that.
2000.
Yeah. 2000. I mean, remember, Janice, we used to be just like 15 of us sitting in a very nice place in Napa and Palm Springs.
Springs, yeah, that sounds right.
So now here's the difference: the corporates can shore up the companies. That's one big difference,
right.
And they can buy them.
Yeah.
So that is a big difference from 2000, maybe even 2008. So that's a huge difference. So first is the bifurcation. The second is that. The third is the types of people that are involved. We didn't have the super angel. Remember back then, you could only go to Cambridge Angels.
Right.
There weren't these, let's aggregate all these people platforms that you can raise, like a Miles, right? You can raise an aggregate amount of money to keep you afloat for a while.
Yeah.
So you have more sources of capital. You have kind of the democratization of venture capital that has gone on. So I think that's how more people, but the one thing that is the same is the venture voyeurism always, right? Okay, they won't go public. The iBankers come in. No offense to anybody here. The iBankers, the hedge funds come in. They put crazy valuations in. They did it in 2001. They did it in 2008. They did it now. And then the rest of us who really are venture capitalists stay here and are here for the long haul. That's the same.
And Tiger is selling their portfolio.
And that's great for me because I'm going and buying the things at low cost, the things that are good, because they can't tell the difference because all those people left and are now at their next hedge fund. So, sorry, but that's what I see.
I told you it would be fun.
Yeah.
Miles, where were you in 2001? Qualcomm?
2001, I was at Qualcomm, yep. And so back then I was doing my first investment in actually a spin out from MIT, a battery company.
Yeah.
And A123.
That was ahead of the game in sustainability, wasn't it?
Yeah, exactly. Yeah. Ahead of the game, yeah.
And so how do you, as you're building Deeptech Labs, does that experience that you had then help now?
Yeah, absolutely. I mean, I think you kind of, you know, having seen the cycles, you can, you know, start to recognize the pattern. I do agree that now is a really interesting time to be investing. The question is how soon the market will come back. But I think, you know, valuations are much more reasonable. I think, you know, that you've, you know, as investors, there's a great opportunity to go in and invest in some of those companies that maybe would have been more challenging and would have much more competitive rounds. So I think it is a great time. But also, I think there's a lot more support. And certainly, I mean, ecosystem, you know, as I said earlier, is super important. And I think there's a lot more support, and specifically around deep tech. So I think deep tech is really challenging. And so I think it's a really good time to be, you know, an investor, an entrepreneur. It's going to be a little bit of a rough ride for a little while. But if you've got a great idea and a great technology, I think it's a really bright future.
You know, George, it occurs to me that as a portfolio manager, you have two conflicting messages to give entrepreneurs. One in the sense is, look, it's real and it applies to you, and start thinking about your burn rates and stuff like that. On the other hand, we do live in a world that is cyclical and it will get better.
So as I said earlier, I'm maybe one of the few pessimists. I think we haven't hit bottom. I think it's going to get worse.
Okay.
And I want to give a little context.
Please invest in venture soon. Is that right?
Yeah, but I'm not. It's not gloom and doom. Just to give a little context, I'm a former firefighter, a real one, and firefighters,
Wow.
by definition, tend to be optimists.
Where were you doing that?
In the Air Force.
Right. Where?
Actually stationed at Misawa Air Base in northern Japan.
Yes.
That's where I learned Japanese. So we didn't have a lot of fires. But you have to believe that you're going to be able to come out of the building. You don't run into a building if you think it's, you know, going to be fatal. But the thing is, I think we got into trouble over the last couple of years because of undue optimism. It's great. It's going to keep getting good. And I think if we send the wrong message now, I'd rather send a pessimistic message and people are like, you know what, it's going to get worse. Let's stay disciplined and they'll get through it. If they go, oh, it's turning around, the economy's looking good, people are coming back, there's a lot of dry powder, then they'll lose that discipline. And, you know, there are some really good companies and they will get funded, but I'm worried about the ones in the middle that lose that discipline and they don't make it the next 12 to 24 months. Even if the economy gets better.
Eileen, react to that?
So the other big difference I forgot to say is the geopolitical, I mean, I'm an ex-Gito person, the geopolitical tensions that are happening. Because that's the case, everybody wants their own supply chain. So there is a $50 billion chips bill going into the United States that's going to fund a lot of technology and therefore
And Japan and Europe.
and here and NATO, the NATO's. Yeah. So we might be okay because the governments. I mean, we just listened to MP George Freeman, right? Yeah. And so, what did he just say? 50 billion, of which he controls 75%. That's a lot of companies to prop up. So it might actually be okay because of a government intervention. And so even though those middling companies, if they have, so here's a difference. If you're a semiconductor company in 2008, God help you. Like the only people who are investing were ourselves at Applied and Samsung and Intel. Now, if you're a middling semiconductor company, you're going to get funding from the governments because it's a national security interest. So that's why maybe in certain sectors, I think it'll be okay.
Oh, there will definitely be sectors that'll make it.
But especially the tech ones.
What are you telling your portfolio CEOs?
What are we telling them? Well, first of all, be cautious on your burn, and instead of these kind of go big plans.
Yes, but Miles, you just gave me money. I'm trying to create, the next great. I'm going to convert all this carbon dioxide into green chem. What are you talking about? Slowing down? Well,
I think all of it is. I mean, we always think, and I'm sure many of you do as well. It's all around sort of getting proof points, right? So, and I think if you've got excess cash, then you try and do maybe everything at once, and you maybe aren't focused. I think especially in deep tech, you have to be really focused on what are you trying to prove. You've got a certain amount of cash, you've got a certain runway, what are you trying to prove? You need to prove that the technology works. Can you get some early customers? And maybe you shouldn't be doing some of these other things around, larger ecosystem building in the short term, And so I think just being, more focused, and then, when the time is right, then raise more money, turn up the burn, but just be cautious, right? To think through that very carefully, and also, as always, engage with those future investors early. Start to build that story, to build that trust, so that when you are ready to go, that you can sort of then bring those investors on board to be able to sort of take that next step.
Do you think, Miles, that this venture capital sort of being of interest to more and more different entities is the case? And actually, government's one, but there are other things you were telling me just about other corporates wanting to come in.
Right.
So in other words, is the case of using venture capital for innovation just ever more compelling?
I think so. I mean, I think a lot of corporates, so as you mentioned, we've got a number of corporates who've come to us and said, we love what you're doing. Could you run a program for us around climate? Could you run us a program around silicon? And what they're saying is, with our larger funds, if we invest, there's a lot of carrying overhead, there's a lot of, and also potentially biasing those companies. But if we can work with an independent party, we get to see all of these companies, we can engage with them early, we can build those relationships. So when it gets to Series A, Series B, we already know them. And we're also looking at, in the silicon play, what's really interesting, we've got one sort of lead partner, and they're saying, we want to bring all of those different stakeholders together. So, you've got EDA tools, you've got fabs, you've got IP providers, all of this. And so I think there's actually a really interesting play on the corporate side to be able to come together and I think add a lot more value to the portfolio companies to give great access for the corporate. So I think that's going to be a really interesting model, especially since we're at sort of seed, and a lot of the corporates now, you're doing growth, but also, and a lot of folks are doing Series A and B. So we think it's a really interesting model there.
If I could just follow up on one thing, I actually say this internally as well. I think the fact that Toyota has an early stage fund, Toyota Ventures, and Woven Capital growth stage fund is a superpower, because so many corporates have the early stage fund,
right?
But if they really want to write a large 10, 20, 30, $40 million check, they have to go to their board of directors. The approval process is much slower and much more difficult, whereas we just have to go to our investment committee and we operate just like a fund. So I actually think that we can make those leaps on the growth stage much faster than our competitors.
And I think also having them separated, because I see some of the large funds where they've got, $1 billion they've got to deploy. Well, putting in $500,000 into something just doesn't move the needle. Whereas if you've got a smaller fund specifically on that early stage, you can really focus on that, and then the growth you can really do. So I think, but I think you do need that stage before to start fueling all those different sort of stages.
I had a question back there, just so you know.
Okay, was there a question?
Have a question back there before? Was it you who raised your hand? No? Okay. Just cut it. Okay, never mind.
I think after some water.
Okay. Well, all right. I'll get to the next point. I have no idea what we're doing on time, because this has been saying zero for some time. Eileen, given what your fund is doing, has the belief in technology in your space become more so as a result of this incredible effort by humanity to find a vaccine for COVID?
Yeah. So if my partner up here, she would tell you that, and she's a trained physician. She is a professor at Cornell. She was chief medical officer at McKinsey. She would tell you that, first off, it's a very broken system in the United States. People still use fax machines. It's impossible. And that maybe 3 years ago, pre-COVID, no one would ever go see their doctor via Zoom call. But of course now, more than half, that's what you do. And so there's a real tailwind in that industry to utilize technology that has been used for the surveillance economy, effectively, into that sector. So how do we understand patients from a 360 point of view? Can we use novel databases, novel analytics? How do we kind of get the right drug to the right patient at the right time? Just like how can Facebook figure out where you are at the right time and show you the right ad? Let's use that technology, but do so for humanity and good and getting people healthy. And not just rich people, but people we saw what COVID did, which is the people were at the bottom, or if bottom of the economic pyramid, or if they were of color or they were women, they didn't get the best care. So let's take all this wonderful electronics that places like Qualcomm and ARM and Applied enabled that are now low costs and have this watch. Let's use that so that we can make it fair to everybody, so that they can get the same patient care you and I all enjoy because we live in, first world countries with access. So of course, and these are, people, I love people in the healthcare and life science. Not that I didn't like the high-tech people, but high-tech people care about share price and, tech, and they forget the output of that, which is, the impact on people and their health. And so they're just so great. It's so nice. The people in health are so grateful when they see, oh, you mean I can use that to track somebody and give them the right thing, and I don't have to rely on my piece of paper and sticky note. I mean, so it's a wonderful sector to be in.
And I think you've just done a brilliant thesis for your fund.
Well, I've only pitched it 500 times, Chris.
George, you live in a technology company. I mean, you're called Woven Capital because Toyota was a weaving company a long time ago. What do you say to people, if there are any in Toyota, who say, well, technology isn't the only answer, surely?
Well, I would say that's true for everything. I mean, at the end of the day, the technology is only as good as how it's deployed and used. And so, as Eileen was just saying, a lot of the tech companies are looking at share price and trying to increase their margins. But for us, technology is about making a safer world. It's not about, airbags will make an accident less dangerous to the occupant. Well, we want to avoid the accident from happening in the first place. Can we use technology to reduce the number of accidents, to eliminate them? We're actually focused on creating the safest mobility in the world. Autonomous vehicles are a way towards that, but at the end of the day, unless every vehicle is connected and they're all talking to each other, you still have to deal with society and the constraints that are put on it. And sometimes it's government constraints.
Right.
It's an unwillingness to adopt the technology.
If there are no questions, I'm going to go to a final question. And I'm going to start unfairly with Miles. Just a few seconds on your most exciting company that you've invested in so far.
Well, we've got, it's like, so which is your favorite child? But I'll raise,
All right,
one or two
so
quite exciting.
however you want to answer that question.
No, but I mean, I think we've got some, a mix of companies, real sort of swing for the fences. For example, we've got one company spin out from Oxford called Salience Labs. And so
called
Salience Labs.
Salience Labs.
And so it's a silicon photonics play, next generation compute using light instead of electrical signals. If this works, it's going to be an order of magnitude reduction in the power consumption for compute. So, the huge impact that's coming from data centers to be able to cut that by the order of magnitude is just huge. And fantastic female founder coming out of Oxford, great background, really excited about that one.
Eileen?
Also unfair to pick, but I'll pick one that was female-founded, co-founded out of the MIT labs. It's called Empatica. And Empatica effectively has taken ML edge inference and put it here so that they use something called transdermal response, which turns out that about 30 to 40 minutes before anyone is about to have a seizure, they can detect it, they can tell you to sit down, so it can both diagnose and prevent seizures from happening, but it is also used by the pharmaceutical companies for clinical trials in not just epilepsy, but any other things that are to deal with stress, to if you're about to have a migraine, and then later neurodegenerative type diseases. So a real collision of tech, semiconductor tech, moving to the edge, ML with a true application in healthcare. And the reason why I love it is because my niece in the Philippines, who are fairly poor, actually now have this thing that was $100 to monitor if she's about to have a seizure, and now she can go about her day and have a job. So that is one of my favorites and a great, again, female co-founded, originally in Italy, Italian, and helping lots of people.
Brilliant.
Yeah.
George.
So unfortunately, I can't say the name of it because it's the company under which we just gave them a term sheet and we're leading their round. It is really exciting, but since I can't say the name of the company, let me talk about my investment philosophy. The saying, the best way to predict the future is to create it. Well, that's the attitude I take from an investment perspective. What is the future I want to see that I believe in? It's not just about making money. It's not just about some cool technology. It's about improving lives. And so for me, it's really, is this going to make the world a better place? And then the second criteria is, do I like this management team? Do I like the vision and the product or the service so much so that I could see myself working there? Like if they said, George, would you come work with us? If I can't say yes, then why am I giving them my money? And so when I think of it that way, it's kind of like what Miles was saying, like, you're picking between your children. They're all equally great to me because they're all places I would love to work. They're all places that I believe are very mission driven and they're trying to change the world for the better. And so from that criteria, I think, going back to the start of this panel, venture is at a really important inflection. And I think that this cycle is different. I just don't think we've hit the bottom yet. But that's good. That just means more upside when we hit it. But I do think it's a really great time to be a venture investor.
Great to invest in funds because funds invest over time. I'll leave it there. Ladies and gentlemen, thank you so much.
Yeah, thank you. Thanks, Chris.